Hey guys, it's Richard. You're watching The Plain Bagel. I want to apologize in advance for what will probably be a light on frills video because I'm trying to rush this piece out to discuss what's happening right now in Ukraine. As you've probably heard, as of Thursday, February 24th, Russia has effectively launched a full-scale invasion of Ukraine. It started with Russia recognizing two separatist regions on the eastern side of the country, and has since evolved into shelling of various cities across the country, including Kiev, which is Ukraine's capital. And while Russian President Vladimir Putin has offered some pretty dubious and questionable justifications for the invasion, ranging from preventing an unspecified genocide to denazifying the region, whatever that means, it appears likely to most people that this is simply Russia's attempt to help rebuild the Russian Empire and reclaim influence over Ukraine from the West, who gained a lot more sway over the region following the collapse of the Soviet Union in 1991, when Ukraine became independent. And for all intents and purposes, Russia and Ukraine are now at war. Now, obviously, there are much bigger concerns than what's going on in the market right now. Some are calling this the worst European crisis since World War II, and the humanitarian cost of this invasion could be massive and horrific. It's honestly a scary situation to imagine anyone going through. My heart goes out to the people of Ukraine. But obviously, there will be an impact on markets, and we've already seen an impact on markets. And while not top of mind for a lot of people, and rightfully so, I did want to touch on why this war will impact markets and how it will impact markets, because you'd be forgiven for not fully understanding why North American stocks might be down. We've seen that Russian stocks are down roughly 40% on the announcement of the invasion, and that makes sense because they're involved with the conflict. It might not make as much sense why American positions or even Canadian positions are down on this news. So I wanted to take some time to explain the situation as it exists, because it's during times like these, during these sorts of crises and severe situations, that people tend to become fearful and panic and make decisions about their portfolio that might not necessarily be in their interest for the long term. So my hope is to provide some perspective and insight onto why people are nervous and what to make of that, because as you'll see, it might not necessarily make sense to jump ship just because things are getting rocky. But with all that being said, we'll hop into it. So it seems like the impact on America from an economic standpoint will be pretty light. After all, the conflict is sort of happening on the polar end of the globe to the US, and Russia and America don't really have very strong economic ties. Trade between the two is very minimal, and the US has actively isolated itself from the Russian economy because it's been trying to restrict influence of Russia and protect its security interests from Russia. And so far with this invasion of Ukraine, President Biden has voiced his intention to stick to sanctions and economic sort of consequences versus military action. Those sanctions are likely to involve restricting access to US dollars, and there's even been discussion of restricting SWIFT payment access, which, if you aren't aware, is an important fund transferring system for banks and for the financial system. So for these reasons, you'd be forgiven for believing there wouldn't be much of an impact, if any, on North America from this Ukrainian crisis. But even still, there are a few reasons why North American markets, and even areas such as cryptocurrencies, have suffered as a result of the news of this invasion. Some of which will likely have an impact on North American stocks and the economy as a whole. For one, the conflict will likely lead to a rise in certain commodity prices. If you aren't aware, Russia is a big exporter of, among other things, natural gas and crude oil, especially within Europe. Now, obviously, I know that we are trying to move towards a more renewable and sustainable kind of economy, but as of currently, those commodities are still very important for economies around the world. And with most European nations condemning Russia's move here, there's likely to be a cutoff of Russia's supply in these areas, which will have consequences for European nations. For example, we recently saw that Germany is stopping production or the process of approving the Nord Stream 2, which is a natural gas pipeline between Russia and Germany. Natural gas prices have been spiking just shortly after dealing with an energy crunch that was already rampant in the continent. And the Brent crude price benchmark, which is a global benchmark for oil prices, has surpassed $100 a barrel US dollars for the first time since 2014. And the problem is that outside of the price of natural gas and oil itself, These higher prices will likely lead to a phenomenon we're already well familiar with, our old friend inflation. More specifically, cost push inflation. Because oil and natural gas play such an important role in fuel and manufacturing and many other products and services within economies, an increase in those prices will likely translate into price hikes for other things. And that will likely cause cost push inflation in an economy on top of what we're already experiencing thanks to the pandemic and monetary stimulus. So obviously, when you have nations already dealing with high inflation and you add this risk of further inflation on top of that, it's spooked a lot of investors and a lot of markets. Russia is also an exporter of certain rare metals, and obviously any country that has direct ties more than the US will see an impact from these Russian sanctions, and those will trickle into other areas as well. You know, if the US trades with a country in Europe that trades with Russia, well, any deterioration of that relationship could have consequences for America's relation to that middleman country, if you will. So there are larger indirect implications here outside of what will directly impact Russia. Now, the second reason that markets are nervous is that even though many nations have talked about sticking to economic sanctions over military action, there is, of course, the risk that this evolves into further conflict, that other nations are drawn into the conflict, including the United States. As you may be aware, Ukraine was actually trying to join the NATO alliance before this invasion happened. The NATO alliance was effectively built to fend off Soviet Union influence back in the 40s and 50s. And even though the Soviet Union has collapsed, that alliance still exists. And an attack on one NATO member from Russia would likely prompt intervention from other NATO allies, which obviously would greatly tip the scales in this war if Ukraine had managed to become allied with the US and many other countries. They are obviously allies, but within the context of the NATO agreement. Now, currently, there's no treaty obligating the United States to enter war here. And one of the reasons that Biden is avoiding the discussion of military action is because there's really no desire to do so. Economically, it would stretch government resources much thinner than they already are. And you have to remember, coming off the back of the pandemic, the US has spent a lot of money to hold the economy through. And so with inflation rates rising and interest rates likely to be hiked, it'd be very, very expensive to expand military capacity to take on a more direct action, if you will, in the Ukraine region. Even still, there are a lot of concerns that this will obviously evolve and that nations will eventually find themselves pulled into this conflict. And there are even some concerns that countries like China, which has had similar problems as Russia when it comes to neighboring countries, there are concerns that China might be bolstered by this sort of move and itself cause further conflicts, which naturally wouldn't make anything better. And finally, the third reason why markets are nervous is just the general uncertainty and unknown indirect effects this will have on economies. It's easier to quantify things like how crude oil exports, cutting that off will impact markets. It's harder to know how deep the roots go. When it comes to relationships between Russia and other countries, and then those countries' relationships with North America, how that will be impacted by these sanctions. And one of the big concerns with the US canceling SWIFT payments, if you will, is that there are European banks that have lent money to Russians. And if you cancel the system for transferring funds, those banks might not get their money back. So it's all those concerns that really make investors more wary. It's why Evergrande caused such a ruckus when we saw that kind of real estate problem in China, which is still kind of ongoing. It's not because Americans inherently had exposure directly to real estate in China. It's because of those relationships between China and other countries that were harder to quantify, that if something were to collapse in China, the ramifications that you would see elsewhere, the fallout, if you will. Markets are by and large an emotional structure, an emotional system in the short term. And when people and investors are nervous and scared, it tends to reflect in stock prices. And in fact, this is why you see a lot of more speculative, higher growth and future-oriented positions like tech stocks and in some cases cryptocurrencies. Why a lot of these have been the hardest hit by this news of the Ukraine invasion is because these are positions that are kind of relying on a future state, if you will. They're promising this large future return. Well, when that future becomes less likely or people become more pessimistic of the future, it's those areas that have higher valuations that tend to be the hardest hit. In the industry, they say that investors are shifting their sentiment to risk off. And it basically just means that investors are less willing to take a risk on future returns. There's sort of the shift away from, big promises in the future towards more security now. They want to take a safer bet, and that's why we've seen things like US Treasury yields dropping, because people have rushed into US Treasury bonds, which are kind of deemed as being risk-free. So between inflation, the potential for war, and just overall negative sentiment, you can see why we've seen North American stocks, especially kind of in the growthier areas, taking a pretty dramatic hit from the Ukrainian crisis. So what's an investor to do in this situation? Well, obviously there's no way of knowing what the future will bring. It's a scary situation. It's currently unfolding, and even as I'm making this video, there are sure to be material changes by the time this video goes out. But I do want to highlight that historically, when it comes to war, long term, they haven't been devastating for at least the US market. Now, it's not to say that war is not generally devastating. Of course it is. But it is to say that the economy has proven to be pretty tenacious over many different crises. In fact, there's a great table I found from LPL Finance, which is a private wealth management group from my understanding, that compares the S&P 500's return over various periods and over various international crises over the past century. And it found that, on average, interestingly, the total drawdown as a result of these crises only averaged 5%. And in fact, even though most wars caused the S&P 500 to drop initially, and in some cases had longer, more painful kind of points of deterioration, over a 12-month period, the majority of crises ended with the S&P 500 being up, again, after a 12-month period. As an example, if you look at World War II, which, if this is the biggest crisis since World War II, well, this is the biggest European crisis, the Dow actually averaged a positive annual return of 7% from 1939, when the war began, to late 1945. So you can see that there's not a direct correlation between war and the stock market. Now, I want to be clear that that does not mean that this conflict might not cause stocks to drop further, that it might not see a drawdown even after a 12-month period. Every crisis that we've seen, every war, has been during a unique financial and economic time, during a unique backdrop, if you will. And so every situation is different. Even that World War II period, well, that was after the Great Depression, which clearly brought the US economy to a rock bottom low, a jumping point, if you will. It is to say, however, that war itself is no reason to assume the end of equity markets, and that markets have proven to be resilient to many, many crises over the long term. And that's kind of the important point here. Obviously, in the near term, things can get really volatile, even for safer bets, safer companies. But if you're a long-term investor and you understand your positions and you know what your company's situation is, their finances, how much debt they have, how they can survive a period of lower revenue and things like that, if you've done that research and you understand the companies you hold and you intend to hold them for the long term, then you should be able to withstand events like this. Long term, a lot of Canadian, American, and other companies around the world will obviously survive this. The initial pain that these things cause tends to subside over time. Time outlives most tragedies, and that's true in the stock market. Now, obviously, this is with the S&P 500, right, which is a pretty broad index. And when it comes to individual positions, it's harder to say, whether they will do well, whether they will suffer, or whether they might not make it. But as I've said before many, many times, the time to adjust your risk-taking is not after the event that, causes that risk occurs, but before. It's to monitor your risk at all times so that your financial situation is isolated or at least somewhat protected from severe events like this. Not gambling all your money on risky bets, hoping that times will always be better further down the road, because there will always be a hiccup along the way. And I do sadly think that the last few years have convinced a lot of amateur investors to chase really speculative plays, in the areas like cryptocurrency, meme stocks, and inherently higher risk positions. But when you're dealing with your long-term, retirement savings and, how much you're saving for yourself to be financially independent, it's important to always keep an eye on risk, not just when things get scarier. So while it might not be the time to adjust now, after the fact when the markets have already dipped or crashed or whatever, hopefully it's a lesson, for the long term to always keep an eye on risk, because it plays a really important role in your portfolio's performance over the long term. Sure, people have higher risk positions that they sometimes take on, to try and experience different areas and get exposure to things like EVs and whatnot. But if your portfolio is entirely electric vehicle companies and cryptocurrencies, you might want to reevaluate your risk tolerance, I guess. because it's probably not that high. Anyway, guys, that's a video. I hope you found it helpful. Obviously, the situation is very quickly developing, and there's going to be information that even as this video is posted might have changed by the time this stuff gets out. But I wanted to touch on it quickly and rush this video out because, like I said, it's during times like these that people might make rash investment decisions. At the very least, I wanted to offer some context and perspective on the situation so that you have more information at your disposal. Just remember, if you're a standard long-term investor, to keep that long-term perspective. And yeah, I hope all my viewers are doing well and that you're safe and your loved ones are safe. It's a scary time, and yeah, we'll just have to unfortunately wait and see what happens. Thank you for watching. We'll see you in the next one. Bye.